Welcome back to the fourth video of our series Building and Explaining a CCA Comps Trading Multiple Tool. After building our simple multiple Excel tool, we will analyze the data and multiples, thereby explaining the concept of relative valuation and topics as well as pitfalls to check when using multiples. Brief disclaimer, we just describe one exemplary way on how to approach multiples, and this is by no means the only or right way. So let's get started. First of all, we will check if we collected the correct data. In this respect, we will also dig into selected data of our sample comp set. Please note that we do not check every number, as this would take too much time for our video. Therefore, we recommend checking every number if you're running an automated Excel tool, as this could have some impact on valuation, as we will show you in a minute. As a side note, if you're asking yourself what an analyst at an investment bank is doing, that is one part which will keep you up in the late hours. So first we check if our tool collected all the data we defined in our previous video. As you can see and as discussed, there might be issues with some data points. Basically, this is the ordinary housekeeping before starting to take a deep dive into the numbers. As you can see here, we have some issue collecting shares outstanding, therefore we just copied the value of 2022 for LTM 2023 and 2024 expected. You should, however, check the most recent data. We just simplified this step, and this is something you should do with every number. So let's begin with shares outstanding at BMW. As you can see, CapitalIQ has roughly 640 million shares outstanding in its database. If we look up the number in everybody's favorite finance study book, Google, we arrive at BMW's IR section and see that this number already includes preferred shares, which we have as a separate line further down our model, and most importantly has a different share price than the one we are using. Unfortunately, the CapitalIQ formula for total preferred shares is not working properly. Therefore, we also have to manually input the value of the preferred shares, which is just the number of shares outstanding times the respective share price. To give you an overview what the impact of our adjustments we are now manually inputting in our model will be, we simply add an adjusted version of the comparable company we are editing to show you the according multiple change in a minute. So regarding most recent data on shares outstanding, you should check the stock exchange data in our case, and for illustration purposes we choose the RR section to manually adjust the shares outstanding. Next, we look at net debt calculation, as this also represents one major component of our EV calculation. As an example, we choose Ford Motor Company and look up the respective CapitalIQ data and the 10Q as of June 2023 of Ford, as this represents the latest available financial data. Looking at the total debt and the cash position of CapitalIQ, we notice that on the debt side, the Ford Credit business is included. But on the cash side, the Ford Credit business is excluded. Ford Credit is the lending business financing vehicle sales for consumer and non-consumer segments, in that it is generating growth for the manufacturing through the support of vehicle sales via financing as well as leasing activities, and has a significant volume looking into the financials. Therefore, the apparent question is, why is cash not included So looking into the notes, we see the following table, which separates the balance sheet figure in the Ford manufacturing and Ford credit part. Further down, we also see several tables looking at the cash equivalents and marketable securities of the Ford manufacturing business accounted for as available for sale. However, there is no further information on the credit cash position, giving any insights if there are any limitations or restrictions on a respective amount of roughly 13 billion US dollar. So looking in the 10K of 2022 of Ford, we find more information on available liquidity of the Ford credit business. In 2022, the net liquidity amounted to 21 billion US dollar, with cash making up 11.2 billion US dollar, which is roughly the according balance sheet amount. As you can see, it is often not quite obvious which position should be included and which not. Therefore, we should always dig deeper to understand the nature, for example, of this net liquidity and its impact on the overall valuation, as the whole credit business has quite a volume. For the moment, we just add back the relevant Ford credit cash position manually, roughly 11 billion, to arrive at approximately 40 billion. However, based on that and looking at other OEMs, it might make sense to calculate the total EV as sum of the part of the manufacturing and credit business, as the credit business is touching a different competitive environment, business model, asset structure, and is valued differently than the manufacturing part. However, you would also need to carve out the credit business from all figures, etc., which is quite difficult, but in the end could lead to a better understanding of the dynamics and certainly the value creation. Please let me know if you're interested in such a valuation, and we will dedicate a separate video on that matter. Next, we take a look into pensions and take the year 2022 of General Motors as an example. First of all, we check the according audit data function of CapitalIQ and see how pensions are calculated. As you can see, there are several pension-related figures in the pop-up, so we go ahead and look up the according balance sheet in the 10K for 2022 of General Motors. As you can see, CapitalIQ collected the pension data directly from the balance sheet. So it seems this is correct, but maybe it is worth digging into the notes. And here we see that General Motors has different pension schemes in place, defined contribution plans and defined benefit plans. So I will not elaborate in detail on the differences, but in a nutshell, contribution plans are primarily funded by the employee and benefit plans are funded by the employer. The major difference is that in case of benefit plans, the employer bears the risk to pay pensions and accordingly prepare financially to service the future benefit obligations. This requires certain administrative efforts and investment strategies to meet the financial commitments in the future. Hence, companies invest a certain amount in different assets, like an investment fund, to have enough liquidity for their pension obligations. In that, there are also assets in addition to the pension liabilities, which have a somewhat offsetting effect on the pension obligation, which we include in the EV calculation. Therefore, if we look up the according note, we see the following overview of obligation and plan asset development. In this table, you see the funding status of the obligations, how the plan assets perform compared to liabilities. In case of GM, we have a funded status for the US pension benefits and unfunded status for the non-US pension benefits and global OPEB plans. Based on that, we have to correct the CapitalIQ data, as we are only interested in the total obligation or in the amount which is not covered by the plan assets. In detail, the unfunded status. So as with Ford, we adjust the amount in a new column or line to see the effect on the multiple in a minute. So here we added the 7.7 billion in the General Motors column and the respective line regarding the annual report data. Regarding minority interests, you basically follow the same approach, check the database data and sources if there's anything wrong. However, typically minority interest is straightforward and there should be no surprises. Next, we exemplarily choose a profitability KPI to show potential items or topics to consider when analyzing EBITDA, EBIT or net income. Generally, you should always look for a sustainable profitability KPI, meaning that one-offs or extraordinary items which do not relate to the core business of the peer are not considered. In that, you should make sure that the figures shown give an undistorted and timely consistent view on the financial performance of the company. As a brief example, let's again look at BMW and precisely at the EBITDA data. Here you can see a position totaling $7.7 billion labeled unusual items. So this should make you curious to check what this could be, and after some digging in the 2022 financial statement, you find out that BMW acquired a majority in a joint venture, leading to a full consolidation of the financials. In this case, there is no need to adjust the figures as this represents the core business and is also sustainable. If this position would have been, for example, a sale of assets which are a one-off or not related to the business, or a sale of an investment in another company, you should evaluate if such a position should be included. Regarding the like-for-like analysis, you should also evaluate to adjust the respective KPIs in the past to have a comparability when looking at the historic development of the respective multiple. And finally, for today's video, we have a look on a common issue when looking at companies which have different exchange rates regarding filing and trading data. In this case, we look at Geely Automotive, which is listed in Hong Kong and hence trading in Hong Kong dollars, but reporting in Chinese yuan. In this case, we simply have to adjust the share price from Hong Kong dollars to Chinese yuan to arrive at a consistent market cap and hence enterprise value. At this stage, a brief side note on exchange rates. As we are looking at a share price, we have to take into account the actual exchange rate based on the share price date. The same would be true if we look at balance sheet information as of the reporting date, as this also relates to a specific date. On the other hand, P&L data is referring to a time period, while you should use an average exchange rate over the respective period, as for example sales is generated over that period and not on a specific reporting date. This just as a brief note. So as I said, that should be sufficient for today regarding the data check. As said, these are just examples on potential issues or topics to take care of when looking at multiples. You should optimally check every data point in the spreadsheet if there is a false data point, missing data, or other things which might influence the financials. However, this could be quite cumbersome. Therefore, as always in life, you should find a balance to identify the really important things, as we will show in a second what the impact of the above topics is on our multiple calculation. Having said that, we now check what the impact of our adjustments are and compare the adjusted multiples to the purely collected data. So as you can see, the differences in our case are quite small, with Ford having an EV impact of roughly 4.5 to 5 billion, translating, however, into an almost 1 times EBIT multiple effect. So based on that and the purpose of your multiple valuation, there could be quite an effect on the overall valuation. Therefore, as I said, always check your data and assumptions. So last, we have a brief look at the multiples, starting with EVs. We see that Tesla is far above all the other companies listed here. The high EV also results in multiples that are close or above 50 times. However, this is not related to poor performance. As you remember from our previous video, high multiples could also result from very low profitabilities. In case of Tesla, the market capitalization and hence the share price is the driver of the multiples, as the profitability is also above the competitor level. But not that much if you look, for example, at the Mercedes-Benz group. Indeed, the share price of Tesla is also below its 52-week high. As you can see in our added column, the column here just represents the percentage of the current share price in relation to the 52-week high to show some extraordinary developments in the current share price and to give you some insights if there is something you should further check on the share price side. If you look, for example, at Geely, the low EV results in higher multiples, especially EBIT, as there's obviously quite some DNA in place. But looking at the big picture, you see that there are quite some significant differences in valuations. For example, Ford has a pretty high valuation looking at EBIT multiples compared to Mercedes-Benz, although margins of Mercedes are significantly better than Ford's, so apparently profitability is not the sole source of this valuation gap. However, if we look at, for example, sales growth in form of a CAGR, we see that Ford is growing and is expected to further grow, whereas Mercedes seems to be even shrinking in terms of sales. Hence, the market is perhaps taking into account the growth aspects of Ford. To briefly show you how this relationship translates into valuation, we simply create a bubble chart with sales growth on the x-axis and EBITDA multiples on the y-axis, with bubble size showing the EV level. In addition, we added a trend line to perform a simple regression to see the mathematically calculated relationship, including the significance of the stats meaning r squared. As you can see, there is a relationship which is apparently driven by Tesla, but growth potential has an impact on valuation. So maybe we can prepare a bonus video on these kind of regressions, as there are, of course, a multitude of factors which can drive valuations. As always, this is just a quick review of the data and multiples and does not represent a thorough and complete analysis of our peer group or the respective market. However, it should give you an idea on how to approach multiples, interpreting the data, and finally get some conclusions on any dynamics within the peer group or market. There are a lot of topics to factor into your analysis, like profitability, growth, but also company-specific topics like location, products, business models, shareholders, and so on. Therefore, it is always necessary to get an understanding of the peers' markets and its financial data before coming to a conclusion. That's also the reason why relative valuation should always be used carefully, as multiples are a pretty simple way to quickly arrive at a valuation. But as we try to point out, the simplicity could have its price either on the calculation of multiples or on the comparability of the respective peers. Therefore, always question your valuation and try to get as much detail you need for your purposes, but don't get lost. With that, we finalize our series building and explaining a CCA comps trading multiple tool. I hope you enjoyed the video and got some understanding on how multiples work and what you should consider when utilizing multiples. We would highly appreciate any comment or question you have, and please do not hesitate to contact us if you are interested in the model or any other topic. We are always happy to support. So just drop us an email to the address in the description to get in touch with us. Thank you very much, and bye-bye.